Hey everyone, Vinny Samra, Impact Financial. This is your channel about everything finance and money. And today we're going to expand on another video on Index Universal Life. And this is how you can get tax-free income loans from your Index Universal Life plan and basically fund a retirement. There's three criteria of a core investment, three criteria that help you escape taxes, market volatility, and beat inflation. These three things are what hold most people back when they make an investment. So if you can overcome them, that's probably a sound investment, and that's where you Index Universal Life Plan. They are accumulating money in a cash value account, and they're accumulating it without any taxes on your gain out. When you do take out a loan, you're taking out that money without paying any taxes because of the IRS code 7702. It's a tax law that states that any loans are untaxable. So yes, you're taking out a loan, and in your mind, you're thinking loan. It's really not a loan. You're giving yourself money, right, without having to pay taxes on it. And the loan rate is so low, as was discussed in a previous video, which I'm going to put the link to here so you guys can watch it. Your loan rate with Nationwide, let's say, which is a company that we recommend, is 5%. Okay, but that money that you loaned yourself on an index, you're still earning 7, 8, 9%, whatever your index that you chose, and typically an S&P 500. All right, so you're earning more than what your loan amount is. So you're making a spread. You're making a profit on your money that you loaned yourself. Or strategy, I don't know of any other. We here at Impact Financial didn't find any that gives you this flexibility and allows you to make money using arbitrage. If you look up arbitrage in the investment dictionary, and this is one of the ways that some of the most savvy investors make money in their market volatility. How do you beat market volatility? With an Index Universal Life, when you take the money out of your cash value account, that cash value account, it's still accumulating money, and it's never going to go below zero. They have floor rates, 0% floor. You can't lose your money. All right. So even if the market goes down 19.4% like it did in 2022, you're not losing any money because there's a 0% floor. Now, there are caps as well, and I'll touch on that. We'll include some information on that in the blog link so you guys can get some more information and understand how that works. But cap rates, they're usually 10, 12. With Nationwide right now, it's 12.75% on the high cap index, which is the one that we would recommend you get yourself into if you're going to set yourself up with an advisor. 12.75. The market, on average, returns about 9%. This is the S&P 500 index. The 500 largest, greatest profitable companies that are in the S&P 500 index, a lot of them are tech companies. Some of the top companies in there are tech companies, Apple, Uber, all these companies are profitable, and the average return of all of them combined is about 9%, and this is going back 30 years. An Index Universal Life Plan, if you choose the 12.75% high cap index, well, that's higher than 9%. You are capped at the 12.75, so that is something that you should consider. This is not a get-rich-quick scheme. You're not going to get rich overnight, but you're going to be in a safe investment that does not have the volatility of other investments out there. Is one. Everyone tells you, every investment money manager that you talk to when you get closer to retirement age, they say, put your money in bonds, put your money in bonds. Well, they are affected by multiple factors outside of your control. Expect to get the same money that you paid to buy that bond, you may not get that same amount back. Yes, you'll earn a coupon rate, sort of like an interest rate on your bond because you're loaning the money to either a corporation or the U.S. government. The value of those bonds, if the interest rates go up, when you bought that bond, let's say you bought it 2 years ago, and now the interest rates are double what they were 2 years ago. This is a current situation. Well, the bonds you bought 2 years ago, they're not worth nearly. Let's say you paid $1 for the bond, it's worth 65 cents today. Big risk. You don't want that volatility affecting you when you need liquidity. Let's say you get sick or you want to buy a new house, or you want to renovate your home, let's say, or buy a business. As you hit retirement, 65 years old, an average retirement age, The last thing you need is market volatility affecting your investment. Okay. Inflation is the last piece. You want to beat inflation. Any investment you have, if you can't beat inflation with it, which right now it's running at about 3-4% for 2023, well, it's not a great money that you put into that investment. It's losing value with time. Inflation erodes the value of the US dollar. And with the high inflation, the cost of goods is going up. Well, your dollar is worth less and less. And if you've invested your money and it's not beating that 3-4% right now, you've got a problem. So index universal life, these loans, you take the money out, whatever money you take out, it's still earning you 7, 8, 9%, which is far greater than the current inflation rate of 3-4%. It's about double that. All of these three things can be taken care of with an index universal. Another thing that we found, the ability to shield taxes from a windfall, a business sale, or a big investment windfall. So let's say you have $1 million in your account by the time you hit 65, which should be everyone's goal at least. And you decide, instead of putting money into my policy, there's cash value sitting there at $1 million. I want to start taking that money out. Okay, now you can probably take out between 5-7% of that money right there every year, because it's going to be with the accumulation that you're getting with $70,000 easily. You can up to 90,000, let's say. If you work with a personal advisor who analyzes this on an annual basis for you, when you're taking out loans, you want to make sure that your cash value doesn't decrease or entire contract doesn't go down the tubes. You want to make sure that there's enough cash value in there and you can take out loans safely and it continues to grow in value, the cash value, so that your loan is never too large. That's very important. So anyway, you have a windfall coming up, or you're going to be selling your business in 5 years. You can do wealth planning. The way you do it is you can take money out of out of the cash value, these loans, and those loans, you want to make sure they add up to whatever your windfall is going to be. So if you're going to make $1 million, so starting at 65, you start taking out on an annual basis, and this is where you're going to work with a personal advisor to organize this. You can take a small portion, and that adds up over 5 years. Let's say you take out $200,000 a year, and that adds up over 5 years to $1 million. At that point, once you sell the business, you can take that $1 million that you made off of your business sale, put it back into your index universal life. You paid off the entire loan, and because it's a new investment, it cannot be taxed. So that windfall, now you don't pay any tax on it because you paid back the loan. So if you like some of the ideas that are discussed in this video, please comment, like, subscribe to our channel. We'd love to bring you guys more content. If you want to learn more, I'm going to put the link in the description below for the blog, and you can get more information and follow us for the next video. Until next time.